So I think that when you have super oversold levels, bonds potentially become tradable if you have views like that. But in general, I think that what makes this so we've already seen that this cycle is very different than the average cycle for the bond market. Normally, for example, when you have PMIs rolling over, other signs of economic deceleration, even when they're still positive, when they're rolling over, normally you start to get bonds doing quite well. But because the first part of the cycle was stagflationary, so you had decelerating economic period but rising inflation. So that was bad for the bond market. And then, somewhat surprisingly, even when inflation started to roll over and stabilize, and you still had a low period of economic growth, you still had bad performance in bond yields, in large part because they were, for a while, they were still below the inflation rate. So they still had time to go up. And then now I think it's just largely a supply demand problem.
Financial expert Lyn Alden dissects the complexities of the bond market and economic cycles, revealing unconventional patterns that defy traditional expectations. Alden emphasizes the atypical nature of the current economic cycle, marked by stagflation and unique fiscal interventions. She delves into the intricate interplay between supply, demand, and various industry specific factors, offering valuable insights into why bonds might not behave as anticipated. Alden's perspective challenges conventional recessionary norms, emphasizing the need for a nuanced, sector specific approach. As she unravels the intricate layers of this economic landscape, Alden paints a vivid picture of a market where industry disparities are magnified, leading to unexpected outcomes. Stay tuned to the end, where Alden unveils a surprising revelation about the future of various sectors.
There's just so much supply coming to market, and that's contributed to by the fact that when you have a strong dollar, foreign sectors not really buying treasuries. You have the Fed reducing their holdings by letting them mature. You don't see banks buying them anymore. So you had years and years and years of bank holdings of treasuries rising, and now that's rolling over. And so really the only source to absorb all of this is domestic non-bank balance sheets, which has trouble with the amount of absorption that we're having. So even if I think there will be times where bonds are a tradable, on the long side, it's not a market that I'm quick to get into because I think that there are more interesting risk reward opportunities elsewhere. Um, and I think there's two periods to be instructive on this. One is again my big theme of the 1940s, right? You can have a kind of economic crisis. It's not disinflationary if you have very, very large fiscal intervention. So that's number one. Number two is if you look at emerging markets, a lot of times their recessions are not deflationary, not disinflationary. And that's because their inputs are problematic. So their energy imports or other things like that. Now they're obviously more prone to have that issue because they have dollar dominated debt. And so they run into issues at a much lower threshold. But I think a big theme of this decade is that, stagflation is in many aspects like what we is normally an emerging market type of issue. And so when you have these unusual fiscal environments, that's where you get kind of emerging market characteristics in developed markets, maybe to a less extreme level, but still kind of in terms of flavor, in terms of direction, that kind of situation. So I don't think that bonds are going to behave, and they've already not behaved the way you normally expect in recessionary conditions. Now, as it relates to the probability of recession, largely it will depend on how much the Fed keeps pushing with rates and balance sheet reduction where they are. But I'm thinking of this less in terms of broad based recession and more just thinking very specifically industry by industry. And you actually see that in emerging market recessions as well. If you have a country with a currency crisis, for example, you'll see many parts of that economy suffering, but for example, companies working in the export sector are often doing quite well in that environment. And so you have very kind of industry specific differences that grow larger than normal. And so in an environment where you have such a large fiscal deficit, but then you have such aggressive tightening attempts by the central bank, that becomes very sector specific and balance sheet specific. So anything that has shorter duration debt, a need for refinancing, overall less creditworthiness, is likely still going to be in a world of hurt for a while. Whereas either if you're in a strong balance sheet condition, so you've locked in low long term fixed rate debt and you have low overall net debt. Some of these companies, for example, the higher the Federal Reserve raises interest rates, the more stimulatory it is for them because
Mhm.
their cash equivalents are rising in yield and their debt's fixed. And then, if you're on the right side of the deficit, so for example, if you are receiving retirement benefits and all that's going up with inflation, and if you're a healthcare company receiving all those very large Medicare payments, if you're an upper middle class or wealthy retiree with a lot of money markets, cash equivalents, and you look at this ballooning interest expense, that's going to someone, that's going to certain entities, either certain financial companies, certain individuals, and their spending is still likely to be relatively intact. So I think another period to look at is when you look at the dot-com bubble recession, so the early 2000s recession, that was by most metrics a fairly mild recession in terms of like how high unemployment rate went or how problematic real GDP was, even though you had very significant sells in the equity market. Um, I kind of view this as that type of recession, not necessarily in terms of the equity market, but in terms of, in that recession, you did not see oil prices crash. You didn't see a super big spike in unemployment. I think we could see similar types of situations like that, where it's a weak environment. It's certainly recessionary for some industries, but I'd be very industry specific rather than just thinking in terms of are most things going to be good or most things going to be bad. I think the difference in industries is going to be larger in this cycle.
In the next discussion, Lyn Alden navigates the intricate maze of the current economic landscape. She starts by debunking traditional expectations in the bond market, highlighting the impact of stagflation and unique fiscal interventions. Alden emphasizes the sector-specific nature of this economic cycle, challenging the notion of a broad-based recession. Delving deeper, she identifies commercial real estate as under pressure, cautioning varying impacts based on loan structures. Despite this, Alden remains optimistic about energy companies, citing their resilience even in the face of reduced oil demand. Their robust balance sheets, coupled with strategic debt management, position them for significant upside potential in the future growth cycles. Alden advocates for conservative investments like T-bills and healthcare companies, emphasizing stability. She also ventures into the realm of cryptocurrency, particularly Bitcoin, acknowledging its volatility but recognizing its potential amidst the uncertain environment.
So I think it's not a surprising answer, but commercial real estate continues to be under pressure. Now, that doesn't mean that it necessarily impacts everyone in the chain. So, for example, if you gave a very low loan to value loan to a commercial real estate company, you could still come out intact or with like a mild haircut compared to the entity that actually owns the equity in that commercial real estate. So, depending on the severity, it doesn't necessarily blow through everything. But that's obviously an industry that's still pressured. Um, so I think that's probably the worst. The areas I'm still constructive on are energy companies in general. And the way that I look at them is that the upside versus downside ratio, in my opinion, is very strong. I think that, if we do have a bad enough recession to cause some degree of oil demand to go down, these entities are still reasonably priced. They can make money in either current oil prices or even if oil prices go down $10 or $20, they're still making money. They're still at reasonable valuations. Most of them, especially the larger ones, have good balance sheets. So they're in many cases in a situation where they've issued a ton of low rate fixed long duration debt and they have a decent amount of cash. They've used a lot of their recent profits to build their cash position, to let existing debt mature off their balance sheet, and not issue as much new debt to cover that. So in many cases they've really improved their balance sheets. And then when we eventually get either another liquidity pulse or another PMI reacceleration, some sort of next growth cycle. I don't know if that's going to happen next year or the year after. But when we look deeper in the 2020s, I think they still have a considerable amount of upside. And so I'm still pretty constructive overall on that market. And then aside from that, I'm sticking to relatively conservative things, T-bills, cash equivalents, healthcare companies. And then I mean, obviously another volatile play I like is Bitcoin. Um, but of course, even in this sort of weird environment, I don't know what it's going to do for a 3-month period.
Thank you for tuning in to this eye-opening analysis. We hope you found this discussion insightful and thought-provoking. Remember, understanding the complexities of the financial landscape is crucial in making informed decisions about your investments. If you appreciated the insights shared in this video, don't forget to hit the like button, subscribe to our channel, and click on the notification bell so you never miss an update. Share your thoughts and questions in the comments below. We love hearing from our viewers. Stay informed, stay vigilant, and most importantly, stay ahead in your financial journey. Until next time, take care and invest wisely.